So on Canvas for the February 24th class, I posted some screenshots. So there's a folder in the Files folder on Canvas for February 24th that you'll probably want to reference. And I'm going to start out with the screenshots for Coca Cola. So after your midterm exam, when you come back from spring break, we're going to start building out valuation models of companies, right? And this is an example of a valuation model. So I'm a few weeks ahead of this class with my master's version of this class, and we've already done valuations of Coca Cola and Starbucks. So this is the valuation model for Coca Cola, Coke stock, that we did, I think, last week or week before, sometime in the last 2 weeks. Anyways, as part of the Excel model that we build, we're going to convert the economic statements for real companies just as we're doing it for the hypothetical companies. And we're going to have a multi-tab model. And one of the tabs in our model is going to look just like this. And this tab creates what's called the ROIC tree for a company. And so one of the things we're going to do is we have to understand the past in order to help us predict the future. So the ROIC tree helps us understand the past. So a key value driver of a company going forward is its ROIC going forward. So the ROIC tree helps us understand what's been happening to a company's ROIC historically. Specifically, we're building out a 5-year historical ROIC tree for big companies. So this is the 5-year ROIC tree for Coke. Now, when we do the economic conversions now, we're doing it based on what's called BOY, B-O-Y, ROIC, which stands for beginning of year ROIC. NOPLAT divided by previous year invested capital. This tree is based on EOY ROIC, which stands for end of year, which is this year's NOPLAT divided by this year's invested capital. All right, so it's like a current ROIC. Right? So EOY ROIC is current year ROIC. So you'll see there's 5 years worth of historical data, and this is for Coca Cola, and there's a percentage change over that 5-year period of time, in this case between 2009 and 2013. Now, here's what we're going to do. For any company, manufacturing or service company, there are 3 things that determine the change in ROIC. 3 things that primarily drive your ROIC. Always 3 items, and they're reflected in this tree. Item number 1 is the tax rate. Item number 2 is the operating margin. Operating profit, or EBIT, divided by sales. Item number 3 is the overall productivity. How much invested capital divided by sales or revenue you have. Those 3 things explain ROIC. Margin times cycle time, margin times productivity is ROIC after tax. Right? So what we're really trying to understand is, as those 3 things change, how do those 3 things explain the change in ROIC? So, looking at Coca Cola. In 2009, their after-tax end-of-year ROIC was 40.2%. In 2013, their after-tax ROIC fell to 26.2%, which means their ROIC fell by 35%, 34.8% over the last 5 years. Right? So what we want to do is explain why. Why did their ROIC go down? Well, the first thing is we can look at the tax rate of a company. So in 2009, Coke's tax rate was 22.8%. In 2013, their tax rate was 24.8%. Which tax rate is better? 2009 or 2013? 2013. The 2009 tax rate is better, right? Which means that the higher taxes that they're paying now would have helped or hurt their ROIC. Would have hurt their ROIC. So taxes could be one of the reasons why their ROIC went down. Is it the primary reason? And the reason we know it's not the primary reason is the after-tax ROIC went down by 35%, but taxes only went up by 9%. So if we strip out the impact of taxes, the pre-tax ROIC, the return on their actual business, went from 52% to 34.8%. right? So really, the challenge at Coke is not that they're paying more taxes, right? That's hurting them, and I'm sure they're not happy about that. But the real challenge at Coke is that the pre-tax performance of their business is going down. And that's something we can clearly see in this tree. So, why is the pre-tax ROIC going down? Well, it's going to be a function of the operating margin times the productivity. This times this, actually this times 1 over this equals that. So, they have equal weight. What happened to their operating margin? Or how much profit when they sell something? Well, in 2009, they were generating 26.6 cents of operating margin. By 2013, to sell the same soft drink products, they're making 21.8% of operating margin, a decline of 18%. Right? So did that help or hurt their ROIC? That hurt. They're making less profit per unit of sales. Productivity. Here's the way to think about productivity. Invested capital divided by sales. To generate $1 of sales in 2009, they spent 51 cents of borrowed money. To generate the same dollar of sales in 2013, they spent 62.7 cents of borrowed money. Which number is better? 2009. So they're now spending more to get the same sales. They've decreased their productivity by 22.8%. So actually, if you look at Coke, all three things, all three drivers are working against them. They're paying more in taxes, they're earning less in profit, and they're becoming less productive. But if we actually look at the magnitude, what really matters to Coke is the productivity hit is the greatest to Coke, followed by the profitability hit, and then the tax rate is hurting them a little bit, but not as much. All right, but they're experiencing two problems. They're making less profit on every unit, and they're spending a lot more to sell their products. As a matter of fact, the formula for cycle time, saying the same thing in a different way, is I take invested capital divided by sales multiplied by 365. So if I wanted to look at their cycle time went from 186 days to 229 days. So using language we used earlier this semester, Coke is now making 21.8 cents every 229 days, where before they were making 26.6 cents every 186 days. They're taking longer to make the same amount of profit, right? But this chart is not in days. This ROIC tree is just the same formula for days, just not multiplied by 365. It's just looking at the pure productivity. So that is what I would call the first level of analysis we have to do for any company. Using those three drivers, explain what's happening to the ROIC. First level of analysis. Now we're going to go on to the second level of analysis. What on the income statement explained why the operating margin changed? What on the balance sheet explained the change of productivity? Right? So, income statement. Gross margin minus SG&A minus depreciation and amortization equals operating margin. So, this minus that equals the operating margin. So those are the three primary income statement drivers. Gross margin is a proxy for markup. It's the difference between the price minus the cost of goods sold. Right? So the price per unit minus the cost per unit. So it's how much markup, how much pricing power that we have on our products. Well, at Coke, their gross margin went from 68.2% to 64.9%. They lost basically, about 3.3 cents of gross margin. Coke also spent on selling general and administrative expense, SG&A. They went from 37.7 to 38.9. So Coke is spending more on SG&A to sell units at a lower margin. Third, Depreciation went from 4 to 4.2. Now I know that went up by 6%. It's the biggest change, but it's the biggest change in a very small number. So percentage change is important, but we also have to look at the magnitude of the size. And so depreciation went up by 0.2%, 0.2 cents per dollar, but therefore it doesn't really have much of an impact. The real impacts to Coke were the drop in the gross margin and the increase in the SG&As. That led to the decline in the operating margin. Right? Productivity. OPWC stands for Operating Working Capital. PP&E is property, plant, equipment. So spending on working capital, spending on property, plant, equipment as a percentage of sales, and intangibles. Intangibles is goodwill. So it's the price premiums paid for acquisitions. Right? So let's look at Coke. Working capital went from 6.6 to 4.5. Did that help or hurt their productivity? Is a higher number better or worse for productivity? A higher number is worse for productivity. Because the idea is, how much do I have to borrow and spend to generate the sales? So in 2009, I needed 6.6 cents of working capital to generate $1 of sales. In 2013, I need 4.5 cents of working capital to generate the same dollars of sales. So working capital actually was more productive. PP&E, property, plant, equipment. Think of this as utilization of facilities. In 2009, I spent 30.9 cents on my facilities. In 2013, I spent 31.9 cents on my facilities per dollar of revenue. Better or worse? Worse. But if I think about it, my invested capital to sales went from 51 to 63, so it really went up by 12 cents, and my PP&E went up by 1 cent, and my operating working capital got better. So really the productivity hit at Coke came from intangibles. They went from spending 13.6 cents to 26.3 cents, or a 10 cent per dollar increase in spending on acquisitions and intangibles. So Coke was really hurt by declining margins and some big bets in acquisitions, which probably didn't get the growth that they had hoped for. And the reason I could say they didn't get the growth that they had hoped for is because per dollar intangible to sales went up. Right? They're not getting a lot of leverage out of the intangibles. Right? So that's what I would say about Coke. Coke's pre-tax ROIC went down dramatically because of a drop in margin, an increase in SG&A, and spending on intangibles, spending on acquisitions. Those were the three secondary drivers that explain the overall drop in pre-tax ROIC, which explains the overall drop in after-tax ROIC. On your midterm, as part of your group projects, this is what you're going to have to talk about. This is the write-up of the ROIC tree. This is what we're going to have to practice doing. Now, context. I wouldn't have expected you to say any more about the ROIC tree than what I did, but I'll give you some more context to what's been happening with Coke. That about 2 weeks ago, Coke reported their earnings, and when they reported their earnings, they disappointed the market. And one reason they disappointed the market is because they didn't get the growth that the market had expected. And simultaneously with announcing their earnings, they announced $1 billion worth of cost cuts, right? To basically say, look, we're not getting the growth, but at least we're getting rid of expenses. And what I'm telling you is that has actually been playing out over several years. And what actually is happening with Coke can be traced to 2010. So if you go back to 2009, Coca Cola Enterprises is actually the bottler. Coca Cola Company is the actual company that you invest in, ticker symbol KO. CCE is actually a separate company. And it goes back to the founding of Coca Cola. Is that when Coke was founded, Coke actually started two companies. Company number one had the so-called secret formula, and they basically created the syrup, which they then sold to a bottler. The bottler would then take the syrup, take the carbonation, take the glass, take the cans, mix it, have all the inventory, have the mixing facilities, have the trucks, distribute it to the stores. So Coke would actually sell, not to you, Coke would sell to the bottler. The bottler would sell to the supermarket or whoever. We actually would buy primarily from the bottlers. Now, the bottlers were a low-cost, low-margin business, high-cost, high-investment, relatively low-margin business. Coke itself was actually an extremely profitable business because it didn't really own any assets. Right? It was basically just a people business with a formula and some syrup. They weren't owning any of the actual cans of soda or bottles of soda that we would buy. That was the bottlers. So here's what happened. In 2009, Pepsi bought its bottlers. In 2010, Coke started buying its bottlers. And you might say, gee, why would Coke suddenly buy its bottlers where it wasn't buying its bottlers historically? And part of the reason is that Coke was losing control over its distribution because its bottlers were starting to distribute non-Coke products. And that was perceived as a threat to Coca Cola. Right? So let me give you a metaphor of another news article that came out this past weekend. It had to do with Comcast. What was the news article relative to Comcast? Yeah, so last week Comcast purchased or announced an intent to purchase Time Warner, which if the FCC lets this one go through, I just don't know. Well, like, why do they even bother to do competitive evaluation if they let Comcast buy Time Warner? But here's the thing. Why is this a big deal that last weekend Netflix and Comcast made a deal? And I'll go back 2 weeks ago. What happened? There was a significant thing that happened 2 weeks ago that caused the Netflix-Comcast deal to happen. Anybody know what it is? Yeah.
Comcast buying Time Warner.
It was before the Time Warner acquisition. There was another thing that happened. Yeah.
Did that move streaming to the Comcast user base?
Basically, the FCC has rules for what they call net neutrality. And what net neutrality rules say is that anybody can use the network to send, data bits, and the companies themselves, the Comcast, the Verizons, can't discriminate on what data goes through. They have to treat all data equally. Well, that got challenged in court, and 2 weeks ago, a federal court overruled the FCC and said that law that I guess it's kind of a law, it's a mandate from the SEC, they overturned that mandate. And so net neutrality currently does not apply. So immediately after that, Netflix saw a 30% drop in its streaming speed on Verizon and Comcast. So Verizon and Comcast basically said, we're just going to slow down the bandwidth of Netflix and go to Netflix and say, if you want your bandwidth restored to its previous levels, so that now that House of Cards is on and everybody wants to binge watch House of Cards, it's almost unwatchable on Verizon Fios because Verizon is slowing down Netflix. So Netflix said, we don't want this to be slowed. And previously the FCC, by mandate, said you can't slow anybody's traffic. But once that mandate went out, they basically started slowing it. So what ended up happening is what happened this weekend. What was the news announcement this weekend? Netflix is doing what? They're paying Comcast to stream at the rate that they used to stream 2 weeks ago. So essentially they're being shaken down. And by the way, Comcast is about to buy Time Warner, so there's going to be even fewer choices to get the content to your homes. So I'm just telling you, taking away net neutrality is a boom for the distribution companies because they control who goes through their channels to the end user. And I'm telling you, it's a bad idea to A, let Comcast buy Time Warner, and B, not to rewrite these net neutrality rules because it's just going to mean higher prices. Because these people are monopolies and they're behaving like monopolists. How does that metaphor apply? Coke's bottlers. Coke has to go through the bottlers, just like Netflix has to go through Comcast in order to get to their end users. And the bottlers were starting to wake up to the power that they had over Coke. And they were starting to exercise the power over Coke, so Coke wasn't getting the margins that it used to. And so Coke strategically decided to buy the bottlers. They said, number one, we want to control who goes through the pipes. We want to make sure that, particularly outside the U.S., that we lock down all these other drinks that the bottlers were trying to send through. And two, we want to make sure that we don't have to pay higher prices to the bottlers, because we need the bottlers as much as the bottlers need us, because without the bottlers, we can't get our product to the market. And the bottlers were starting to raise price against Coke and take advantage of them. So, long story short, Coke bought the bottlers. Part of the reason is that Coke should make more money and grow more sales now that they control the bottlers. The problem that we're seeing in the numbers, this didn't occur. That what Coke did is they bought their way into a lower margin business, because the bottlers always had lower margin than Coke did. So Coke now has lower margins, but Coke didn't see the growth. And the reason they didn't see the growth is because they spent more in SG&A as a percentage of sales. The reason I spend on SG&A, selling, general, administrative, a lot of marketing expense, is because I expect that marketing expense to translate into even more sales. So I don't spend money to get less sales at lower margin, and essentially that's what started to happen to Coke. So the point is, their strategy hasn't paid off with the growth that they thought they were going to get from these acquisitions. And what I'm saying is, we're seeing that now in Coke's current results, but the trends have been apparent for a couple of years in their numbers now that we can see the trends. Right? This will become important if we value Coke going forward, because we now have to think about what the company's going to do on a go-forward basis, but we can kind of see in this economic format what these numbers are. So that's number one. The second analysis that you're going to have to do is called CFI. Shrink this a little bit. CFI is the cash flow available to investors. So as part of your homework, you converted to CFI. So now what we want to do is we want to explain the CFI. When you answer questions in this class, and this applies to both the ROIC tree and to the CFI, you must refer to specific numbers. You can't just say the ROIC got worse. Because if you say the ROIC got worse, there's a 50-50 chance that you could be right, even if you don't know what the numbers are. So because I don't really know if you're just guessing, or I don't know if you're actually understanding the numbers that are in front of you, I've instructed the TAs to give you zeros on any answer that do not include reference to specific numbers. Right? So in this class, you must not only have the text to be right, but you have to refer to the numbers that support how you're actually drawing your conclusions. That's why you'll hear me repeat numbers as I go through the analysis. In finance, you actually have to show what numbers are important. And that actually plays out in the real world as well. So let's go back to this. CFI. In CFI, cash flow available to investors, there are four major sections of CFI. Operating, which is free cash flow. Free cash flow plus non-operating cash flows equals CFI, and that equals the debt and the equity cash flows. So as part of your CFI analysis, you must talk about what happened to the cash flows in each of those four sections. Ideally, the total is the total of the 5 historical years. So you have to talk about the total of the 5 years, but you also have to talk about individual trends. So let's talk about Coke in the last 5 years. Free cash flow is $21.4 billion. That's the total amount of free cash flow they generated over the last 5 years. $45.6 billion of gross cash flow, which is cash coming from the income statement. Gross investment in working capital and CapEx of $15.9 billion, leading to free cash flow before acquisitions of $29.7 billion. They spent $8.3 billion on premiums for acquisitions, most of it in 2010. That was the bottler acquisitions, generating $21.4 billion of free cash flow. As a percentage of gross cash flow, they had 46.9% of free cash flow available per every dollar of gross cash flow. That is the theoretical payout rate. Well, 1 minus the payout rate is what? It's the investment rate. So what is the investment rate for the last 5 years at Coke? If 47% is the payout rate, then the investment rate must be 53. So one of the things we can quickly infer is that Coke is reinvesting approximately 53% of its profits, right? So that's going to be important as we think about sustainable growth and projecting out free cash flow on a go-forward basis. It's about a half-half strategy, about half reinvestment, half payout. Non-operating cash flows. Coke actually increased its excess cash balance by almost $15 billion. Coke also increased its non-operating assets by almost $13 billion, $12.8 billion. Coke also got a $9.9 billion, or about a $10 billion non-operating gain. When you look at these impacts, they had about $3.6 billion of CFI. So even though they had $21 billion of cash flow available to investors, because they tied up a bunch of cash, and because they tied up a lot of cash in non-operating assets, despite their operating gain, they only had $3.6 billion of CFI to pay out. Right? So what did they do with their cash flow available to investors? They paid out $1.8 billion worth of interest. Positive numbers are payouts. We know that on the statement. They borrowed $27.8 billion worth of new debt. Now it's interesting, why would a company borrow almost $28 billion worth of new debt and increase their cash balance by $15 billion? Well, go ahead. Well, they could want liquidity, so that could be one of the reasons. But I also think it has to do with this tax rate. Notice the tax rate's not 35%. Coke's based in Atlanta. The reason it's not 35% is because where does Coke earn most of its profits? Overseas, outside the U.S. Under current tax law, you don't pay the profits until, or you don't pay the taxes until the profits are brought back to the U.S. Coke is increasing the cash outside of the U.S. Right, so it's really just storing the cash overseas because it doesn't want to pay a 35% tax rate. And it knows it would take a 35% hit if it brought it back to the U.S. So by keeping the cash outside the U.S., they basically are raising the cash. That's the increase of excess cash. That's more than what you would have to say in this analysis. What you'd actually have to say in this analysis is that Coke has increased its excess cash balance. Right? Now, back to the CFI. Here's another insight. They also got $3 billion of cash by not fully funding their retirement plans. So they basically owe an additional $3 billion to their employees. So that's almost $30 billion of new debt. Debt to bondholders, debt to the employees. What'd they do with all that cash? $21.7 billion was paid out in dividends. $18.3 billion was repurchased in shares in the marketplace. They basically gave almost $40 billion to their investors. Now, they also issued $6.7 billion worth of new stock. So net, they gave 18.3 minus 6.7. Let's just call that somewhere around 12 point something, 12.6, 12 and a half, plus 21. So that's about 34 billion. That's 30 plus the 3.5. That's about the 34 billion. Take the CFI, all the new debt to the employees and the bondholders, and that's really what they paid out to shareholders. So they basically wanted to continue to reward shareholders, but they just didn't have the cash to do it because the cash was held overseas. So they borrowed the money to buy back the stock and pay the dividends because all their cash was being earned overseas and they want to repatriate and take the tax hit. Now, from a bondholder standpoint, it's a pretty safe bet to invest in Coke because they issue $21 billion worth of debt. they're generating $9 billion, $10 billion worth of free cash flow in a year, and they have all this cash sitting overseas in a checking account they could quickly repatriate to pay the debt. So I don't look at Coke as being very risky in using this borrowing strategy, but you can kind of see what they're actually doing with their borrowing strategy in the numbers that are here. That they're basically taking the cash and rewarding the shareholders. But that also goes back to the fact that Coke is struggling with its growth. Because what Coke has been doing is they're saying, look, we're going to get more growth. But the problem they had when they just reported their earnings is their gross cash flow actually went down. So that's the point. They're not getting growth. They're not getting growth in absolute cash flow, and they're not getting growth in margins. So what did Coke announce? They announced they're cutting their cost. By cutting their cost, they're basically saying, we may not get more free cash flow through the top line, but we'll give you more free cash flow through optimizing the bottom line because we don't have to pay as much to keep people drinking our product. Our product is addictive. So therefore, they're going to keep drinking the Coke, and they're going to keep drinking the Dasani water and all the other products that we own, and we'll just spend less money to get that product out there. We have some barriers to people coming in because we own the bottlers, and we own the supply routes that go to the grocery stores and the other people, and we'll just optimize the cash flow. And that's how we'll still give you good returns, even though we're not growing as fast. That's the current, basically, strategy that Coke is now articulating in the market. They're still searching for growth, but they're just saying we're having trouble getting the growth right now in the market. So if we can't get growth, we'll optimize, but we're still going to search for growth. And you can see how that plays out with the financial numbers in the CFI. So as I said, that context about Coke specifically, you don't have to know for your midterm exam. You just have to know mechanically that there are 4 sections. You have to at least tell me what's going on in the 4 sections. But that's the point. If you know what's going on in the 4 sections, then you can go and try and backfill your story based on what's happening with the company. That's what an analyst would do that actually understands these companies, right? But essentially, this is parts 2 and 3 to your homework assignment. So on Wednesday, there's going to be 3 parts to your homework assignment. They'll call the jumbo homework compared to the last couple. Number 1 is the economic statement conversion. Number 2 is the ROIC tree analysis. Number 3 is going to be the CFI analysis. You're going to have to write it up. By the way, these 2 are going to show up on part B of your midterm. Okay, so you're going to have to know this how to do this for midterm and as well as your group projects later in the semester. So here's what I'd like to do. I posted to Canvas in the February 24th folder some screenshots, including the Coke ones that we just went over, but I also posted some screenshots from Costco. So what I'd like you to do is take 10 minutes, and in approximately 10 minutes, we're going to go over the ROIC tree and the CFI. But for now, you can welcome to talk about it yourselves in the class with some partners around, talk about the analysis, see if you can do it yourself, and then in 10 minutes we'll get some volunteers to walk through this. And then we'll go through the ROIC tree and the CFI for Costco as another example.